Welcome back to the program. So Kenya is raising at least $1.05 billion through syndicated loans, including $250 million already secured from lenders led by PTA Bank, as East Africa's biggest economy seeks to plug a widening budget deficit. PTA, an East African trade finance bank based in Burundi, has already disbursed $100 million, while a further $150 million will be received by Kenya shortly. Kenya's government outlined plans in last year's budget to raise $1.5 billion from external sources in the fiscal year through to June. The total amount to be borrowed will be consistent with parliamentary approval of external commercial borrowing of 154 billion Kenyan shillings. The World Bank has estimated Kenya's financing gap at 9.6% of GDP in the 2016-2017 financial year, from 7.2% in the 2 years of 2015-2016 previous. Meantime, global oil inventories will start to fall by the second quarter of the year, and crude producing countries will decide in 5 months' time whether to extend their collective output cuts beyond the first half of the year. And that's according to OPEC Secretary General Mohamed Bakindo. Mr. Bakindo says global macroeconomic numbers have responded positively to the agreement between OPEC and non-OPEC producers to pare their output in a drive to end a worldwide supply glut. The cuts began on January the 1st and are to stay in effect for 6 months. Bakindo expressed confidence in the level of commitment from all countries participating in the agreement to decrease global supply. A committee of OPEC and non-OPEC producers responsible for monitoring compliance among member producers will hold their first meeting on January the 21st and 22nd in Vienna. So, back to Nigeria, where a financial research firm based here in Lagos called Financial Derivatives Company is forecasting a decline in Nigeria's December headline inflation rate to 18.3%. That will be the first change in the year-on-year direction in 14 months. If that forecast is correct, that will be a 0.18% haircut from November's inflation level. So what factors will be driving that inflation number down south? Research analyst with Financial Derivatives, Adim Okwesa, is joining us now via Skype from downtown Lagos. Adim, good afternoon, and it's good to see you on the program. Thanks for coming through.
Good afternoon,
where is this optimism coming from?
Well, our projection is based largely on base year effects. If we recall, in November 2015, from November 2015 to December 2015, there was a significant increase in prices based on seasonalities. Well, fast forward to December 2016, although there was seasonal demand, I think this time around it was subdued because of the recessionary impact on the income of Nigerians. So based on all that, we expect the headline inflation index to come down, albeit marginally, by just 1.8%.
Your report stated that even if we see this slight decline in headline inflation, it's not likely to continue. It doesn't look as if it's the beginning of a steady decline in consumer prices. Yes or no?
Yes, we still expect inflation to remain high, remain in double digits, remain above 15%, to be more specific, because there are still a lot of cost push factors. The exchange rate at the black market is still trading at 490 to 492 per dollar. There are still logistic factors, like, for example, diesel. The cost of diesel is about 260 naira, which is about 62% higher than it was this time last year. So based on all those factors, mostly cost push factors, the inflation rate will still remain high.
Okay, so, but overall, is it likely that we'll see anything significantly above 18% in 2016, even though we still keep the double-digit inflation level?
Well, no, I think 18% is long gone. Base is gone, like I said before, base year effects. If you remember, January 2016, the Naira, that was when the Naira started its downward spiral. It went from about 250 to about 300 at the black markets. In April to the fuel subsidy was removed, petrol prices went from 86 naira to 145 naira. So now that those factors don't come into play this year, those base year effects would come into play and wouldn't affect the headline inflation rate.
But of course, you're not looking at 20%, are you?
No, that's far-fetched. No.
Okay, so we'll keep it at about 18% for most of the year. So if we do a bit of a lower trend in December, where do you see January when everybody's back? You're paying rent, paying school fees, most likely petrol prices would be tinkered with. We're not sure what's going to happen with the oil workers skirting around, looking for a way for a breakout to get to the bus stops and carry placards and things like that, shut down oil production and distribution.
Yeah, I think the January inflation rate should trend lower based on two things. Number one being income constraints. Most workers there have been mass retrenchments going on, and even those people that have jobs, they haven't been paid salaries in months. And also, one thing we can smile about is that there has been an increase in productivity in the agricultural sector. That should translate into more food supply, which should depress food prices. So we expect the headline inflation rate to trend lower in January again.
Well, I appreciate that. Adim Okwesa from Financial Derivatives, you put in some smiles there. You see there's going to be some smiles. And we talk about fixed income. You folks also talk about those stocks, talk about the smiles as well. So let's keep the smiles all around things and see how things go for 2017. Thanks for talking to us today, Thursday. Adim, see you in the next future. Let's finish off in the DRC, where the Minister of Mines says it wouldn't oppose the transfer of ownership in the country's biggest copper and cobalt producer, marking a departure from previous actions to block or tax changes in shareholding structures. Glencore says last week he's considering increasing its 69% stake in the Mutanda mining project, also known as MUMI. The rest of the equity is owned by Israeli billionaire Dan Getler's Flotter Group. Congo's government in May announced it will investigate and tax Freeport McMorgan Incorporation sale of its 56% stake in the Tenke Fungurume mining project known as TFM. That should go to the Chinese for about $2.65 billion US. The Congolese government has since lifted its objections, but state-owned copper miner Geka Mines, which owned about 20% of the mine, continues to oppose the deal, insisting that its right to match the offer have been ignored. I should just rest it there for today from the world of Business Incorporated. Well, thank you for watching, everyone. See you again tomorrow, Friday. Bye for now.